All right, welcome to this Explainer Masterclass. I am your seasoned CREA advisor, and today we're going to treat this exactly like a live professional workshop. I'll be guiding you through how to confidently vet your very first commercial real estate deal, and we're going to do it with absolute institutional grade clarity. Look, if you've ever felt completely overwhelmed by the sheer complexity of evaluating commercial properties, or maybe you're a first-time investor trying to bridge that tricky gap from single-family residential over to commercial, you are in exactly the right place. In my years of advising both rookies and seasoned pros, I've seen exactly where these deals fall apart. So we are going to decode the professional frameworks used to analyze those deals step by step so you can finally buy with real confidence. So here is our game plan for today's session. First, we'll look at the power of transparent advisory fees. Second, the investor Launchpad framework. Third, running the desktop Sniff Test. Fourth, a targeted risk SWOT analysis. And finally, expanding your advisory menu. Let's kick things right off with Section 1, the power of transparent advisory fees. Now, traditionally, the commercial real estate industry has relied heavily on transaction-dependent commissions. But notice how transaction-based commissions carry this inherent built-in friction. I mean, the advisor only gets paid if the deal actually closes, right? For a first-time investor, that creates a lot of underlying anxiety. You're constantly wondering, is this person pushing me into this building just so they can get a payday? And honestly, that misaligned incentive is dangerous. Structured flat fees, on the other hand, they establish objective trust before we even look at a single piece of property math. By entirely decoupling the advisory value from that final transactional trigger, you know for a fact that the advice you're getting is focused purely on whether the deal is actually right for you. Your advisor suddenly becomes a true partner and a safeguard, not just some salesperson trying to drag a deal across the finish line. And when we productize that advisory knowledge, three massive advantages pop up. By eliminating that commission friction, we clarify exactly what value you are getting. It literally turns abstract, highly technical underwriting into an instantly digestible menu. For you, the investor, you know exactly what deliverable you're paying for without any hidden agendas. And frankly, for the advisor, it creates predictable revenue outside of exclusive listings, which means they don't have to hustle you to buy something that doesn't fit your goals. It really is a true win-win that elevates the whole consulting relationship from a high-pressure sales pitch into a genuine strategic partnership. I want you to keep this in mind. Sponsors, developers, and institutional investors don't just value transactional facilitation. They pay for structured intelligence. Now, what does structured intelligence actually mean if you're a beginner? Well, it basically means having a blueprint that prevents a million-dollar mistake. You aren't just paying someone to open a door, tour a property, or shuffle some paperwork around. You're investing in specialized analytical knowledge that mitigates massive financial risk way before you've wired even a single dollar in earnest money. All right, moving right along to Section 2, the Investor Launchpad Framework. Stepping into commercial real estate for the first time can be incredibly daunting. As a first-time buyer, committing, say, $5,000 to underwrite a deal you aren't even sure about yet, that's terrifying, and that is exactly why we use the Investor Launchpad. This specific framework is your bridge. It gives first-time buyers, syndication passive partners, and crossover residential investors professional-grade clarity without the massive financial commitment of a full institutional workup. It's really just designed to quickly answer the most important question: does this deal even deserve my attention? And here is the magic number to make that happen: $1,500. As a value hook bundle, you can submit up to 3 potential properties over a 60-day period for a highly accessible flat fee of just $1,500. Think of this as a very cheap insurance policy. It allows you to test the waters, evaluate multiple opportunities, and securely baseline your options before you go committing heavy capital to full-scale underwriting. You get to leverage the brain of a seasoned advisor to filter out all the noise, ensuring you only spend your real time and your real money on the properties that genuinely pencil out. So, how do we actually run those baseline numbers? That brings us to Section 3, running the desktop sniff test. This illustrates the exact steps the big institutions use for high-level desktop validation. Let's break these down, because if you're a first-time investor, all this jargon can be a huge roadblock. Step 1 is validating the capitalization rate, or the cap rate. Simply put, the cap rate is just the baseline yield you'd make on the property in a given year if you bought it in all cash with zero debt. And we absolutely have to validate this against what the market is actually doing today, not just what the seller claims it is. Step 2 is checking the cash-on-cash projections. Since you probably aren't buying the whole building in all cash, this metric shows your actual return on the cash you invested after paying your mortgage or debt service. It's the real money in your pocket. Step 3 is reviewing the Gross Rent Multiplier, or GRM. This is just a quick ratio of the price of the property divided by its annual gross rental income. It gives you a really rough idea of how many years it would take for the property to essentially pay for itself in gross rent. Together, these three metrics act as an immediate, ruthless filter to weed out overpriced assets. But look, numbers in a vacuum are entirely meaningless. We always pair that math with a localized 1 to 3 mile mini market snapshot. In my workshop sessions, I always share the story of a hypothetical rookie who bought an apartment building based purely on a beautiful spreadsheet. I mean, the math looked flawless, but they didn't check the immediate neighborhood. Had they done a snapshot, they would have seen 3 massive, brand new apartment complexes being built right down the street, and that incoming supply completely crushes rental demand. The mini market snapshot securely sanity checks your fundamental assumptions against local pipeline supply threats and current vacancy rates, basically ensuring your beautiful spreadsheet actually matches reality. Which leads perfectly into Section 4, our targeted risk SWOT analysis. Because let's be honest, the numbers are only half the battle. We also have to run a targeted matrix, looking at strengths, weaknesses, opportunities, and threats. This right here is exactly where rookies get trapped. We actively isolate specific small-scale risks before you buy. Take physical assets, for example. We are aggressively looking for hidden, deferred maintenance. If you buy a building and the HVAC system fails in month 3, replacing it could completely wipe out your entire year 1 cash flow. We also evaluate operations. Are you going to hit self-management constraints that force you to hire an expensive third-party management team you never budgeted for? And critically, we analyze municipal factors like strict entry-level zoning limits. If you buy a property planning to add an extra unit or change its commercial usage to boost its value, but the local zoning laws outright prohibit it, your upside is dead on arrival. Identifying these exact risks before you buy ensures they don't derail your operational success later on. Finally, let's look at what happens as you scale. Section 5, expanding your advisory menu. Once you master the basics, your real estate portfolio is going to expand, and your need for structured intelligence will absolutely scale right along with it. As you grow, your needs will shift toward these deep dive tools. For instance, a landlord raising capital from partners might need a premier offering memorandum, which is essentially a comprehensive, highly polished marketing package detailing the financial and physical story of the asset to attract investors. That runs between $2,500 and $5,000. Or if you become an opportunistic developer, you might engage in a complex adaptive reuse study. Adaptive reuse is exactly what it sounds like, converting a property's original purpose into something completely new, like turning an old hotel into residential apartments. That level of heavy analysis runs up to $12,000. The beauty here is the total transparency. You know the exact deliverable and the exact price range before we even start working. Now, we've got to talk about professional boundaries, because they actually protect the quality of the work you receive. By requiring a 50% deposit from major retainers and instituting a strict 2-round revision limit, we completely prevent endless scope creep. If the parameters of the deal change wildly, excess structural updates bill at a standard advisory rate of $300 an hour. Now, why does this strictness actually benefit you, the investor? Because revision limits and upfront deposits mean your advisor isn't out there juggling 100 uncommitted window shoppers. Their time is fiercely protected and highly focused, which means they are fully 100% dedicated to the success and precise execution of your specific deal. So, we've covered the power of transparent fees, the exact mechanics of the desktop sniff test, and how to spot those hidden risks before they drain your capital. The blueprint is literally right here in your hands. So I'll leave you with this final critical thought. Are you going to keep guessing with your capital, or are you ready to leave that transaction friction behind and underwrite your very first deal with true institutional clarity? The tools are ready whenever you are. Let's get out there and build your portfolio.